G'day, welcome to another Closing Bell with me, Charlie Ullman for Fat Tail Investment Research. I'm joined in studio by the Chief Trader here at Fat Tail, Murray Dawes. G'day Murray, welcome back.
Charlie, how you doing? Hello everyone.
Very well, you're welcome back to the cold Melbourne.
Oh, I know.
Back to the reality. Yeah?
Bloody Brisbane's
So
awesome.
good.
So beautiful.
Good. We've had such a busy week on the markets. There's almost too much to talk about. I think what we'll be covering obviously is the big trade deal or trade truce between Trump and Xi. We've got some big movements in uranium you want to talk about and something in lithium as well. I think there's some special things there for some readers, some hot tips, as well as some inflation talk and rate cuts. So, I mean,
plenty going on.
So much.
Yeah, plenty going on.
We've even got the big market movers as well, but we'll talk about that another time. But I think we'll start with inflation, rate cuts. Are they done for 2025?
Well, looking at those inflation figures in Australia, it sort of peeves me a bit that the government is making electricity prices go through the roof with their policies at the moment, and that means they've got to keep interest rates higher to screw us all even more.
Yeah. So
it's
details for the readers. So annual inflation headline inflation, jumped up 3.2%. That's up from 2.1% last quarter. That's the largest jump since March 2023, and 9% of that was due to energy costs bumping up, and a lot of that was the state's energy rebates rolling off. So it's kind of the reality of the energy costs is coming through there. So I mean,
we all know the pain of opening our bill. I do it with one eye.
Yeah, it is. It's bad. It's bad.
Yeah.
So the chances of a Melbourne Day Cup rate cut are almost gone, right? I mean,
probably. Yeah.
I've even heard talk of people saying that maybe December there might even be an interest rate rise.
God,
very unlikely, but just the fact that is in the conversation shows there is a lot of problems going on right now. So
yeah, well, Australia's screwed.
So that's your hot take on it. It's screwed. Well, same thing within the US though, right? They had a slightly better inflation reading, but the Fed delivered its probably final rate cut for this year, they kind of said that they were moving in the dark. Jay Powell talked about fog. He said if you're driving in fog, the thing is to slow down. The market's not really fully believing it. Went from a 90% chance of a cut for December now down to a 72% chance cut.
But the biggest news is the QT, the ending of the quantitative tightening. So that's where it's interesting, where there's been some funding problems in the plumbing over there, so they're sort of nearing the point where they need to slow down the quantitative tightening and get a bit more liquidity into the markets. So that's sort of interesting that we're now at that point, and that's a bit of an inflection point, I guess, to be aware of.
And it did seem like a bit of an inflection point for some of the big tech earners, right? We've seen big bifurcations in the results. Overnight, I think Amazon's after hours stock is up 11%. Meanwhile, Meta was down 11%.
Yeah.
So really depending on that CapEx spending. So it is kind of interesting.
Well, it's just mad, isn't it? The numbers, you look at them, and I've seen a lot of analysis saying, look, these numbers, they don't have the money to do what they're saying, or this circular economy they've got going of massive promises, where who's actually got the money and how they're going to fund it all, and the numbers are just stratospheric and immense, and the business model isn't there yet to support it all. So it is definitely a possible massive accident waiting to happen at some point, but maybe it goes for another year or two. I don't know.
Yeah, I mean, it's interesting because a lot of them had said back at the start of this year that probably 2026 is when we might see CapEx winding down somewhat. They're all accelerating. All of the latest quarterlies, they're all accelerating. But at the same time, all of their cloud revenues are also accelerating. Microsoft's was at 26% growth. That's big growth numbers for such a large company.
But the percentage of their cash flow that's going to investing into this new race, possibly to the bottom, is going higher and higher. And you think something like Oracle, they're now going to go into debt to fund it.
Huge debt.
A huge
amounts of
debt. So maybe they'll be the canary in the coal mine when they go to zero. But you say someone comes up with a good AI, I just switch. What is the switching cost of saying, well, this AI is good, and then someone comes out and says this one's better?
Zero.
Everyone goes, okay, well, I'll go to there. So there's no real stickiness necessarily of the customer at the end of the day. and the revenues are nowhere near what they need to be to cover all of this. And I love it. I mean, I still think it's world changing and world beating, and I'll never not use it again. So maybe it will all work out in the end. But there's
trouble afoot.
The numbers don't stack up at the moment, and I wonder whether there's going to be a comeuppance at some point in this.
Well, you've done some of your own analysis on this, and you brought a really interesting chart in today. So I wanted you to take us through that, because that one really was exciting for me.
Yeah, well, this is on the market breadth. Yeah, so we've got, obviously, everyone knows that there's a few companies all going absolutely ballistic, and everything else is being dragged up as well, and earnings have been pretty good. But you keep an eye on, if there's selling sort of across the board and there's only a few companies going well, it's starting to be it's just a little canary in the coal mine. Watch out, because the market breadth isn't that good. And so we're at all-time highs, everything fantastic. But I'm noticing, because I've just started the new international stock trading service. And so I'm constantly looking at hundreds of US stocks. I've got watch lists I'm building up and that sort of thing. And I'm starting to see a lot of red when I wake up in the morning to look at what's going on. And the market may be up a little bit more, but I'm seeing 3/4 of what I'm watching going down.
Right, so it's like these mega caps are lifting the entire index, but everyone else is quietly
struggling. So the way I'm saying I can show this is with a pretty simple measure, which is this indicator down the bottom here. Is just the percentage of stocks that are above or below their 200-day moving average.
And that's what that middle black line is there.
Yeah, so the middle black line would be the 200-day moving average. Right? And if you're above it, more than 50% of stocks are above their 200-day moving average. If you're below that black line, more than 50% of stocks are below their 200-day moving average, right? So, and the 200-day moving average are a very important technical level on long-term sort of trends. So it gives you a good sense that the long-term trends on, if more than 50% of stocks are below that sort of long-term trend, it's like, the market's a bit weaker than you think.
Yeah.
And why this indicator has actually been pretty good in the past is that it's sometimes given you a nice early warning of what's to come. So I just wanted to set up here to show you since the crash in 2007, sort of every time that we've had that indicator go off, going below the 50% line, what has come after it, I guess. You're saying, okay, it's gone off, and when a market's trending higher, really strong, obviously it's going to do that every now and again. And it's not going to be the indicator of a coming correction. It'll dip down there and then take off again, right? So you've got here where it's sort of retested a few times. But if you look at every big correction that we've seen in the last couple of decades, so here's some pretty good chunky corrections that happened, right? So this is 22. That's the COVID crash here. There's 2018. So, and this was 2015. That was like a year of pretty much going nowhere. You can see that this little indicator actually gave you the heads up early on before the correction really started to get going. So as long as it was all holding above, like see this whole period from 2015 to 2018, it pretty much held above all that way. And then it headed below, and that was actually an early warning sign of the coming correction. So it's got pretty good form in just saying, once it's under, in like this period here, you're saying, well, watch out in that period. And what happened? We had a year of getting absolutely hammered. So, and after this correction, I mean, it never works all the time. Just to show you this period in the circle, after we've had a 2-year correction, the market's then going through a period of saying, okay, am I still in a corrective phase or not? The market will be quite volatile. And so we went through a period here where it sort of went backwards and forwards, and it was slowly trending higher, but it was constantly, giving you false signals on that time because it was in this in-between period after a really big correction. So, I mean,
we were also in an in-between period in terms of the economy, right? It's like coming out of COVID,
is it going to go?
There's so much liquidity sloshing around. Governments are spending. They don't really know what's happening.
So that was a period where it was pretty hard to tell, is it going up or is it going down? And then we went into a nice big run. And you can see here, the first time it's dipped below was pretty early on in this April correction. So that's why I'm saying right here, we've got the stocks right at the all-time high, everything looking fabulous. And where is this? It's been tipping over pretty hard. And it's at 53 now. So it's actually not that far off, even though we're at all-time highs, more than 50% of companies in the S&P 500 below their 200-day moving average. So it tells you that the market breadth is not that great at the moment. So that's the one thing that I'm just in my head going, okay, keep an eye on this. Don't necessarily buy heaps and heaps of stocks right now.
Yeah.
But we still need to wait until momentum actually turns down, because it could just keep grinding higher. Santa rally, blah, blah, blah.
Yeah.
So it's all, the trends are all looking fine, all on the all-time highs. I've got to stay long. I've got no choice because my model says I have to. But this sort of thing is just making me prick up my ears. And if we do get the actual signals of momentum shifting, I think we might be in for a correction. So we'll just see.
Interesting times. All right. The other big news this week we're going to cover on the Trump and Xi talks, and they're calling it the truce in Busan. Right, so the talks, as much as they were a 1-year pause, they were talking about fentanyl, they were talking about chips, they were talking about rare earths. Thus far, it all kind of looks like, same.
Well, I wonder what actually went on, and I'm sure they both had plenty of meetings with everyone outside of it saying, how can we do this meeting and make sure we both don't lose face when we come out and things don't blow up. So, but what's in the end, did China use rare earths as a weapon in the last year, and has America now woken up to that? And the answer is yes. So is America going to now say, oh no, we'll stop our decoupling our rare earths and trying to build a whole supply chain externally from China? We'll stop that now because China was nice in this meeting. It's like fat chance. So America's going to work as hard as they can to decouple from that rare earth risk. China knows it, and who knows when they're going to pull a card or do something. But I think the stage is set now. America knows they need to do something about this, and China knows they have all the cards, really.
Right.
And so they've had a meeting. They've got the soybeans going. It's all, yes, that's nice. But really all they've done is delay that rare earth threat, haven't they, for a year?
It's a détente, really.
It's a détente for a bit,
It's a 1-year agreement. They will look at it every year from
and
that
they're going
point.
back to what? They were buying soybeans. They stopped to piss America off,
lean on the
and now they
farmers.
will be buying them again because they need them probably anyway.
But the buying numbers were not quite. I mean, they were buying $20 billion worth of soybeans annually. Then the last talks they said, oh, we're going to spend $900 million and buy some soybeans. So the numbers weren't quite the same comparatively. We'll see.
Right.
They're still making deals with Argentina, buying those. So the soybeans are just one part of it, right? They also said, look, we'll allow resumption of talks with NVIDIA, so maybe NVIDIA chips might be able to be sold to China again. There was the fentanyl, the actual when the rubber hits the road, it was a 10% reduction in the US tariffs, so it went from a 50-odd% to a 40-something% tariff. But they're constantly changing them, so it's very
and the fight's not over.
No.
They haven't kissed and made up and fixed everything. Yeah, well, so we'll see. And what did the rare earth stocks do? Did they get hammered after this meeting? They're actually up today.
Do you want to look at one of your favorites, Arafura?
Let's have a quick look.
It's been our go-to in the last 3 weeks, and I think it's for good reason. It's been one of those ones that's been specifically called out by Albanese and Trump. It was specifically given the huge amount. And look at that chart. What a run. What a run up.
Pretty amazing. And you can see, again, the major wave to the upside, and that was going to 2023 up to nearly 70 cents odd. Got hammered with everything down to where? Into the buy zone area there. Lots of work done. And again, the false break of the low of that structure. So I like to see these initial waves higher, which is the initial buying, thinking that they're getting on. Lots of buying goes on in there, and they slowly get sucked out, and the stop losses go off below that low, which is the false break. And then the second one is often the one that can go. I'm kicking myself I didn't buy that. I saw this, but thought they needed to raise still, nearly $1 billion or whatever it was. And they're getting debt for a lot of that. And they had to, but the amount of capital they needed to raise compared to their share price at the time, I actually balked at it. I could have got it at 18 cents. And I thought, well, I know that they need to raise so much money. Are they going to do that at 15 cents? And the stock's going to be hammered. So I left it alone. And then I was, you can imagine how I felt when it was up here. at 60 cents. But I think the people buying it at 60 cents didn't realise what the actual situation was of,
how much capital
they needed, right? And so they've used that opportunity. They've seen their price up there, and they've thought, right, this is our opportunity to raise the money, and got hammered. And then they've ended up raising it at 28 cents. And people may remember, I said last few weeks ago, it was up at this area, and I said, look, if it does fall back to this, that is 27 cents, the old high, and back to the longer term moving averages, it could be good buying. So now, though, they're raising this money at this 28 cents. It's a dilution of like 40%. So it's like a massive dilution. But now we're getting to a real situation where they've got the money to move forward with the deal. We know it's all going to probably still happen, this decoupling in the end. And they're probably the closest high NdPr ratio, probably the most advanced project ready to go. And now they're getting the money in the door. This whole period when they're going to be thrashing around people, when you have a massive raising like that, it's going to take time for it to get absorbed and people stagging profits if it runs a bit and that sort of thing. So it can end up being choppy for a while. But I think this area, this sort of 20 cent, I don't know if it'll get back down there, but it easily could. That 28 cent region, I think on this chart, looking at how it's looking now and thinking down the track, could be something worth picking up a few.
For sure. Yeah, I mean, I wrote about the same thing, saying like when it was around 60 cents, I said, hey, this is not the time to buy. You're a bit too late. Wait for a 60 to 40% pullback. Then you might be looking at some good buying. You can see the same thing in Northern Minerals. Same thing. Big run up, capital raise, back down. They're going for that. So it is a thing that's playing out now. So at interesting times. And I think that, as you say, the West cannot bulk away from securing a supply chain that's outside of China. I think the last part of this kind of bull run might be when they start talking actual concrete floor pricing. That might be the thing.
Yeah, exactly.
Yeah. What else has moved this week? We've seen Trump announce more moving within uranium. I mean, there's been so many little stories coming through, percolating through. First, it was the Department of Defense, was now Department of War, announcing they wanted to invest in 18 different microreactors. And now Trump has said $80 billion towards a new Westinghouse nuclear reactor. So what's been happening?
Reactors?
Reactors, sorry.
Yeah.
Excuse me, reactors. So what have we seen within the ASX uranium? It's been a 10% raise within the whole basket of goods, and massive flyers. What was it? BOE? Was it Boss Energy up?
They had their own problems, and so they would be coming back alive again.
Back alive. There was like an 18.5% raise on that. So, I mean, what do you think's been happening within uranium? Do you think this is a long-term bull market beginning, or is this one?
Yeah, I think it's going to carry on. It's already been in a bull market for quite a while. So if we check out this uranium chart, this is going back to 2017. You can see, and this is, remember, post-Fukushima, absolute terrible bear market for years and years. Uranium was dead, or totally forgotten about. And you can see it has actually been in a recovery mode from around 21 is when it really started to pick up. But you can see very long-term, slow uptrend taking shape, isn't it? And it's still quite early days. So this rally that we saw, that sort of $50 up to over 100, and this was Sprott coming in and buying, and everyone just started. This was a couple of years ago, and it shot higher and then went into this correction for a year. So it was still an oversupplied market. Everything's contracted. So the spot market on uranium is a bit different from most markets.
Yeah, it's a bit of a strange one.
It's mostly contracted. And so the spot is a very small percentage of what's actually done, and the spot moving around doesn't necessarily affect a plant that's bought uranium for the next 5 years.
Yeah, some of them have got
at a certain price.
10-year contracts.
Exactly. So but these contracts are rolling off. So we're heading to that point where there's needing to be a roll off. And the thing about uranium you've got to think about as well is there's this massive sunk cost for the plants. Uranium is a very small percentage of the overall cost. So if uranium price doubles, will the plant still buy it? Of course it will. It's pretty price inelastic because most of that sunk cost is what the cost of the energy really is. And so the uranium price itself is a pretty small part of that, and they're going to be buying it. So if there is a imbalance that does develop, there's no reason why this uranium price can't go a hell of a lot higher than what you or I are currently thinking once it gets going. So this and it's all building out slowly, isn't it? Uranium makes sense, and I think this deal with the US is just sort of another flag in the ground saying, okay, this is coming, and that won't be till 2030.
Right.
But you're just saying that this is now getting real. It's sort of starting to be that this is now one of the aspects of the way of lowering greenhouse gases and that sort of thing. This is now seen as a viable way, and with the new tech, SMRs, blah blah blah, AI demand so massive, we know that gas is probably going to take up the slack for the next few years, but ultimately uranium, building those SMR plants next to them, it's just, for me, shaping up as a long-term trend that's got many years to run. And this chart is about as perfect as I can get as far as seeing corrections. I'll actually turn that back to black so it's even clearer. Where you're seeing higher highs and higher lows, right? It's quite clear. It's beautiful. And it's steady as you like at the moment. Now, here was that last wave. So there's your correction over the past year, and everything got hammered. Now, would you say that this is something that has turned around, that this correction may be over? So what we're looking for is how many waves, before it, because this could be just about to do that, right? So what you want to see is signs that it is actually starting to be a trend. So that is one wave, two waves, a pullback. Now the next wave going above, that's sort of the proof in the pudding that this is now a primary wave in the long-term uptrend. So we're very close to this being in a state of actually running and possibly taking out that high ultimately. So this is what we could be in for. And I've done it vertical there because I have run out of space. But I'm just saying that this next wave could actually be quite a big wave.
Yeah.
And if it does take that one out, wow, it can really go. So it's just, the technicals are perfectly set up, and this US deal is just a nice catalyst to get this correction now finished and that primary wave taking over.
And as you were saying before about sunk costs, that also goes into the supply side of it, right? When you're starting these new mines, there is so much sunk cost in the rehabilitation of them, and so there's actually a bit of supply constraint there. And I really feel like that, excuse me, is what this is showing, right? Like, there's not a huge amount of new supply coming online.
No,
Australia's been slowly reopening a bunch
next
of these.
gen, and you've got Paladin ramping up. And there's not that much else. So if things do get out of balance, it can get out of balance quickly.
Right. Yeah. Super interesting. I think it's one of those plays that has been, as you say, slowly percolating. But I mean, every time Trump pushes for new policy agendas within energy, it's always been nuclear recently. It's been the big story.
And I think natural gas is another one to keep an eye on too.
Yep.
People are saying that the shale may be getting close to its tipping point pretty soon. And when you get those sort of huge oil supplies starting to tip over, that can be the beginning of a really big wave higher. And natural gas has been really on its knees. And you can see with Tesla, they had their AI data centers, and they've shipped in all these gas turbines, to run them. And I think they're going to have to do that as a stopgap for a while. So I think natural gas could be one to keep an eye on.
I've been writing a lot about and talking about GE Vernova, the company that is one of the major producers of those gas turbines. It has a 3-year backlog right now. It's kind of crazy. But anyway, maybe we go into gas in depth next week.
Yep.
But what I want to touch on finally, lithium. Lithium's been making a bit of moves, right? We've seen 7 days of positive movements on the Chinese futures.
Yep.
And the Aussie lithium miners are waking up again. Another run.
Well, an upgrade of its lithium pricing because of the battery energy storage systems. So you sort of grid scale batteries, and just imagine how much lithium you need in them.
Huge amounts.
So that, and they said that's like a 50% growth this year and mid 40% growth expected next year. So that total lithium demand is moving from like 30% to 36% or something over the next year or two. So all of a sudden we've got something that really is a big story, because we know for our renewables move that we've got, you're often in the middle of the day, you've got prices at zero, solar's doing what it's doing. We need to balance out overnight so that we're getting these big batteries in, which can, fill up while the price is zero and then release while the price is high at night. So that sort of makes sense that those sort of grid scale batteries need to come into the system as necessary, and necessary firming, and just for moments when things go wrong, to be there to be able to take up the slack very quickly, going on and off, like a gas turbine that can come on quite quickly, but battery can be instantaneous. So instabilities in the system, that sort of thing, they can help with. So it's like, it makes sense. And now if I imagine around the world, everyone trying to get these battery grid scale batteries online, and that they're now finally sort of cost effective, because they've always been just too expensive to make sense. And if it is starting to get to a point where it sort of makes sense, it's like, that's a big uplift in demand for lithium. And I know that EVs it's just a crapshoot trying to work out what's going on.
Sales are up 30%, down 30%.
Europe's here, US is bad, and then they go, China's really good, and then but there seems to be overall that it's ending up slowly sloping higher. Just that slope is not as rapid as everyone thought it was going to be.
It zigs and zags with different subsidies, and different places get pulled and taken
and because
away.
It was a small market to start with, when everyone had these big ideas that it was going to be huge forever, massive supply comes online in a small market that we know is going to be large at some point. But when it's a small market and you bring a lot of supply in, all of a sudden it's way oversupplied, and the sales aren't quite what you want, and so we had a massive crash. So this is, when you're thinking in terms of 5-10 years though, and now we've got these battery energy storage systems coming in as a wild card that can really ramp up, and even EVs are going to continue steadily, and in China they're already really flying and going well. It's sort of, to me, it's like, we might be at a bit of a turning point.
There's also the wild card, just to add in there, of potential robotics or drones,
yes,
right?
Exactly. Robotics. I thought robotics, but that's a 5-year story.
That is a longer story.
It's a longer story, and it's going to take time before that takes in. But so let's have a look at this from the long-term perspective. So we know this is just terrible, right? This has been an absolute bloodbath. How many of you have some lithium stock you bought at $5 that went to 50 cents, and you haven't told anyone about it, even your wife or your husband, because it was just a bloodbath? Everyone thought easy money, and then absolute collapse. And this is what you want to see with a collapse like this, is the rounding bottom, so taking time to play out. And is it now at the point where this is actually turning up from that rounding bottom? So that's the big question we want to know. And if we go into that daily, there are some signs of life, aren't there? And I sort of saw this initial wave higher, and people will know I gave you guys a heads up very early on PLS and Liontown Mineral Resources. You guys actually were first. I'm actually in them in Retirement Trader, but I actually got into them a bit after I gave Closing Bell people the heads up, because I wasn't quite ready to jump. But so you guys got in very early, if you are still in it, that is. But you can see it's like, oh, is this gonna just die again? It's been so hammered, you're just not really convinced. But the fact that it's sort of had this correction and is now just starting to head up again, it's going to be very interesting what happens above here. Is it going to do this? So it's sort of at that point where no one's making much money, and it's all a bit tough. But JP Morgan just came out, and because of the battery energy storage systems, has said we're upgrading, and our long term as well, because we think this demand is actually going to create a deficit in the next few years on lithium because of that alone. So it's sort of like a bit of a go time where that sort of thing starts to happen. And I think we could be in a bit of a recovery phase, and pretty big opportunity when you think about it from a decade point of view.
Long-term investment.
Long-term. Sure. So this is the crash, and this is maybe the turnaround in a really big story. So it's pretty interesting.
It is. It is very exciting. A lot of different places. It's very commodities focused at the moment. It seems like that's the major theme, and that's all we love in Australia. We love hearing that word. So happy days.
Yeah, it does feel like the commodities are possibly turning up, but I haven't seen much in like your lead, your nickel's dead as a doornail.
Right.
All that sort of stuff is not really turning up. Aluminium is turning up though. It is looking pretty interesting. Copper looks great. I think copper is ready to. I think 26 will be the year of copper. I think it could really just trend and trend and trend. So it is. It's feeling like that there is a bit of a switch towards that resources could be the way to go. And this rare earths and lithium story, which we are jumping on, and we'll even look at...
this is Pilbara Minerals.
Pilbara, which... and again, same structure. Looking at the huge collapse, $5 all the way down to below $1. Where did it go to? Right into the buy zone. Monthly buy pivot there, and that's actually when you guys got on. If you were watching, and
let us know in the comments if you got on.
We'd like to know if you got on
about it.
because bam, off it goes. And thankfully I got on. I would have been spewing if I didn't, but my retirement trader people are on. And it's looking great, and the fact that it's busted through this point of control is interesting, and that the long-term trend is very close to shifting as well. So it'll be volatile on the way. Targets sort of to there. It could end up doing whatever it wants to do before it ends up taking off, and you want to be buying to the long-term moving averages. It's sort of a bit above that at the moment, but it's sort of at a point where it could actually surprise. And be difficult to get on. So it's interesting.
I guess we'll leave it there. It's already a lot covered there. There's so much going on in the markets. But maybe in the comments, if you want to hear anything else from us, if you've got a topic in mind, send it on through. We'll see if we can look at it next week.
And hopefully you're still on Weebit.
We'll cover Weebit as well next week. All right. Thank you very much for listening.